A shocking discovery: Macy's accounting in crisis. Macy's, the beloved American department store, is facing a major crisis. The company recently announced a shocking discovery. An employee hid millions of dollars in expenses. This has sent shockwaves through the business world, raising serious questions about financial transparency and corporate responsibility. Macy's is known for its iconic Thanksgiving Day parade and its presence in communities across the U.S. Shoppers trust Macy's to offer quality products and a reliable shopping experience. However, this scandal has shaken that trust, reminding us that even well-established companies can be vulnerable to financial misconduct. The scandal involves a staggering sum of money, an estimated $154 million in delivery expenses that were concealed from investors and the public. This revelation came as a blow to Macy's, which was already grappling with the challenges of a rapidly changing retail landscape. The news of the accounting scandal broke just as the holiday shopping season was kicking off, a critical time for retailers like Macy's. This incident has cast a shadow over the company's festive cheer, leaving many wondering how such a massive discrepancy could have gone unnoticed for so long. Unraveling the deception. How did it happen? The accounting scandal at Macy's unfolded over several years, starting in late 2021. An employee in the company's accounting department managed to conceal millions of dollars in delivery expenses through a series of fraudulent entries. The employee responsible for this deception exploited weaknesses in Macy's internal controls, taking advantage of loopholes and manipulating accounting records to hide their tracks. This went undetected for nearly 3 years, raising concerns about the effectiveness of Macy's financial oversight. The employee's actions involved creating false invoices, misclassifying expenses, and manipulating accrual accounts, all designed to paint a rosier picture of the company's financial health than was accurate. This deliberate manipulation of financial data misled investors and regulators, creating a distorted view of Macy's true financial performance. The complexity of the scheme suggests a calculated effort to defraud the company and its stakeholders. The fact that it went undetected for so long raises serious questions about the adequacy of Macy's internal controls and the competence of its auditing procedures. Macy's takes action, investigation and response. In the wake of the accounting scandal, Macy's has taken swift action to address the situation and reassure investors and the public. The company immediately launched an internal investigation, bringing in forensic accounting experts to determine the full extent of the fraud. The employee responsible for the accounting irregularities was promptly terminated, sending a clear message that Macy's has zero tolerance for such misconduct. Alongside the internal investigation, Macy's is fully cooperating with external authorities, including law enforcement agencies and regulatory bodies, who are conducting their own investigations. Macy's has also delayed the release of its quarterly earnings report to ensure accuracy and transparency. The company is committed to providing stakeholders with a complete and accurate picture of its financial situation, even if it means delaying crucial announcements. To prevent similar incidents from happening in the future, Macy's is overhauling its internal controls, strengthening its accounting practices, and implementing more rigorous oversight measures. This includes enhancing employee training programs to raise awareness about ethical conduct and financial reporting responsibilities. The financial fallout impact on Macy's bottom line. The accounting scandal has had a significant impact on Macy's financial performance and reputation. The concealed $154 million represents a substantial sum, even for a company of Macy's size. This has shaken investor confidence, leading to a decline in the company's stock price. The timing of the scandal couldn't have been worse, coinciding with the crucial holiday shopping season. The negative publicity surrounding the scandal could deter shoppers, impacting sales during a period that is typically critical for retailers' bottom lines. The financial fallout from the scandal goes beyond the immediate impact on Macy's revenue. The company is likely to face substantial legal and regulatory costs, including potential fines and settlements, further straining its financial resources. Moreover, the damage to Macy's reputation is difficult to quantify, but could have long-term consequences. Rebuilding trust with investors and customers will be a challenging and ongoing process, requiring sustained efforts to demonstrate transparency and ethical conduct. Section 5. Rebuilding trust, a long road ahead. The accounting scandal has dealt a blow to Macy's reputation, eroding trust among investors and customers. Rebuilding that trust is paramount for the company's long-term success and will require a sustained commitment to transparency, accountability, and ethical conduct. Macy's must be proactive in communicating with its stakeholders, providing regular updates on the investigation, the steps being taken to address the issue, and the measures being implemented to prevent future occurrences. Transparency is key to regaining trust and demonstrating a genuine commitment to change. Beyond words, Macy's needs to back up its commitment with concrete actions. This includes holding individuals accountable for their actions, strengthening internal controls, and fostering a culture of ethics and compliance throughout the organization. Rebuilding trust is not a quick fix, but a long-term endeavor. It requires consistent effort, open communication, and a genuine commitment to learning from mistakes and emerging as a stronger, more ethical company. Section 6. Lessons learned: strengthening corporate governance. The accounting scandal at Macy's serves as a stark reminder of the importance of robust corporate governance practices. Companies of all sizes can learn valuable lessons from Macy's experience, strengthening their own internal controls and promoting a culture of ethical conduct. One key takeaway is the importance of strong internal controls. Companies need to have systems in place to detect and prevent fraud, ensuring that financial reporting is accurate and reliable. This includes segregating duties, implementing checks and balances, and conducting regular internal audits. Equally important is fostering a culture of ethics and compliance. This starts at the top, with leaders setting the tone and demonstrating a commitment to ethical behavior. Companies should provide employees with clear guidelines on ethical conduct, offer training on financial reporting requirements, and establish channels for reporting suspected wrongdoing without fear of retaliation. By prioritizing strong corporate governance, companies can mitigate the risk of accounting scandals, protect their reputations, and maintain the trust of their stakeholders. Section 7. The Big Picture: Transparency and Ethical Conduct. The accounting scandal at Macy's shines a light on the broader issue of transparency and ethical conduct in the corporate world. It serves as a reminder that trust, once broken, can be difficult to regain, highlighting the importance of integrity in business practices. Investors and the public rely on companies to provide accurate and transparent financial information. When that trust is breached, it undermines the integrity of the market and erodes confidence in the entire system. Ethical conduct is not just about following the law. It's about doing the right thing, even when it's difficult. Companies have a responsibility to operate with integrity, treating their employees, customers, investors, and the public fairly and honestly. The Macy's scandal serves as a wake-up call for all corporations to re-examine their own practices, ensuring they have robust internal controls, a culture of ethics, and a commitment to transparency. Section 8. Looking ahead: Macy's path to recovery. The road ahead for Macy's will be challenging, but the company has an opportunity to emerge from this crisis stronger and more resilient. By taking decisive action, demonstrating transparency, and committing to ethical conduct, Macy's can begin to rebuild trust and restore its reputation. The key to Macy's recovery lies in regaining the trust of its investors and customers. This will require a sustained commitment to transparency, communicating openly and honestly about the steps being taken to address the accounting scandal and prevent future occurrences. Beyond transparency, Macy's needs to demonstrate accountability. This means holding individuals responsible for their actions, strengthening internal controls, and fostering a culture of ethics and compliance throughout the organization. The holiday season will be a crucial test for Macy's as it seeks to win back shoppers and rebuild its image. The company will need to work hard to regain the trust it has lost and demonstrate that it is committed to learning from its mistakes and emerging as a stronger, more ethical company.